Hello and welcome to TheoTrade. My name is Doc Severson and this is the Theo Night Report for Tuesday, September 13th. I'm seeing some really interesting symmetry right now on the S&P chart. So imagine this, we have this, after this initial move down, we have this strong rally that came back up here, and that led to some sideways consolidation, right, as we got into the springtime. And then what we had was we had the Brexit low. So what kicks these off is the initial move down, right? So what kicks off the rally is the initial slingshot move down. So this is very, very common to have markets go down and then it slingshots higher from there. So here we go with this move here, and then guess what? This led to an even smaller move here. And then what we're seeing is now kind of the third act in this is a move down. And whether or not we'll actually see something like this moving into an even smaller range up here, this is yet to be determined, obviously. So it may not play out exactly like that, and is unlikely to. But the one thing that we can see, though, is that when we have this range compression, similar to what we had back over here in the spring of 2015, you can see that as it got down to almost a zero level of realized volatility, that then started to unwind and become unstable. And you can see the realized volatility start to increase here. And this is, I believe, what we are now beginning to see. So we'll probably see some type of realized volatility increase, and ultimately, when we see instability coming into a market, this is usually the result of that. So I'm not calling for a crash right now for this very second. I think that market tops are a process, unlike market bottoms, which are an event. So market tops are a process. So they start out with a shot over the bow, and last Friday could have been that shot over the bow that kind of wakes everything up and sort of serves notice that, guess what, I'm going to become very noisy, very unstable, very difficult to trade going forward. Okay, so how far down is this initial move going to go? Is this it? Or are we just going to go to 2120 and then bounce back up again? I don't think so. I think we still have a little bit left to go. Now, if we look at the actual ES contract, the S&P 500 contract, we can see that we have actually tagged that 2100 level almost to the tick. And that occurred on Friday. Okay, so we had the bounce back up yesterday, and then the move back down again today. So is 2100 the level that we need to watch for? I don't know. But what can help us here is if we look at volume profile. So the volume profile for this right now shows that, yes, we have had a little bit of trading up here. And this is going to become support and resistance levels. So the peaks here. Okay, so what we can see from this is that there's essentially no support or resistance right around this area, but there starts to be a peak in support and resistance right around in this area here. So we're not quite down to that area just yet. So for this reason, I believe that we can still sell down in this area or below in the near term. We can sell options down there relatively safely, because this is going to be a very tough area to chew through on the first try down. Okay, so that's the ES contract, and you can see that it's just a little bit shy of that level. If we actually go out to the spiders are going to show that area just a little bit lower. Again, we still have a ways to go before this is going to come down here. So I believe the 210 level is going to be around the area that we want to watch for the price come down to. So I do want to look for some credit spread fills on the downside down here. And where are those going to be? Well, to answer that question, let's go over here and look at the option chain. And I'm going to go out to the October series for this. And it depends on how far out of the money you want to put your credit spreads. There are some strategies where you want to set them up at maybe one standard deviation. There's other strategies where we set them up at the first strike that's outside of the 50% probability of touching. Other strategies we set up for a minimum credit level, such as like maybe a 15-cent credit on a $2 wide spread. So here's the thing. Remember that right now the price is up here at about 213. So the price closed about 213. So we figured there were probably about another 3 points left to go to the downside. So where does it map out to a trade for us? Well, let's say if we were looking at a 13 delta option entry, right? So that would be for a $2 wide spread, the 195 and 197. All right, so if we sold that one right now, right today, we would get somewhere around maybe about a 16-cent credit, 15 to 16-cent credit, depending on how well we could negotiate that. And a lot of times it's easier to set that up in the first few minutes of the cash open, just because of the volatility is higher. So that favors fills first thing in the morning. Okay, so right now if we say that we could get filled right now, right today, at the 195, 197 for that spread, so that would be approximately 13 delta, 87% probability of success at expiration, probability of touching only about 28%, something like that. So that is definitely a high probability trade, but we have to know what our risk management and how our defense is going to be for that trade. But if we do get the move down another 3 points, we could probably get at least the 192, 194, if not even further out of the money than that, because of the fact that if we do see that 30-point move down or a 3-point move on the spiders, we're certainly going to see a nice spike in implied volatility for that. So we may be able to get something in the lower 190s for that. And if we look at the lower 190s down here, it's going to be down in this area. It's going to be well below the Brexit low. It's going to be down in this area. We're going to have plenty of room to be able to defend that trade or take action should we need to. So this is one of my favorite techniques when it comes to trading credit spreads, is to be able to identify a level that we can, in a way, lean against, right? So if we're looking for that level, we have to set up a level that we say, okay, this should probably be strong support down here. We think it's going to be tough to chew through that area in the first trip through, and set up the trade and then sit back and defend it. Now, the pros with doing something like this, so waiting until the price comes down to this area, is that very typically, unless we step in front of a crash or something like that, which could always happen, but again, we are doing the very, very best job that we can to become patient and to let the trade come to us. So if waiting for the price to come down here allows us to set up something perhaps for the October cycle down here, okay, it's very, very unlikely that the price is going to come screaming all the way down here in the next couple of weeks, unless there's some kind of horrible event that occurs. More than likely what happens is, maybe even if this is undercut, we do get at least some type of a bounce, and even if that creates a lower high, that allows us to be able to perhaps close the position down, because what we'll see is an absolute crush in volatility at that point, as well as the fact that we have a positive delta trade with the price going higher. So both of those are going to compound and make the profitability of this trade occur very, very quickly for us. Many times what we can also do, and this is more of an advanced technique, is that on the bounce back up, that we will still have a relative high level of implied volatility, much higher than what it was back here. And that may allow us to be able to propel a call spread trade up here and fully complete the iron condor in doing so. But in today's environment, I would actually assert that the call spreads are much more liable to defensive action in today's market. So it's kind of like playing chess. You're always thinking a couple of steps ahead of what you can do and what you're going to do in terms of risk management, and be able to set up the very best offensive trade that you can. And the way that I always speak of this is there is no replacement for displacement when it comes to these credit spreads. You want them as far away as you can, at least maintaining a minimum level of credit and risk reward on the trade. Now, I'm sure some of you are saying, well, what happens if the price just bounces from here and goes straight up like this? Well, I wave goodbye at it and I say, have a nice life. It's too bad we didn't get the trade, but this is what it takes sometimes is to be patient, wait for the price to come down to your level, wait for the trade to come to you. And by doing so, you're going to measurably improve your probabilities on the trade. That is it for today's report. Thanks for listening, folks, and we'll see you in tomorrow's video. Take care.